Hello and welcome to Absolute Trust Talk. This is another one of our Facebook Live versions of our podcast here at Absolute Trust Counsel. I'm Kirsten Howe. I am the host of Absolute Trust Talk, and today I have a guest. My guest is JP McDermott, who is a financial advisor with Mass Mutual. I'm going to introduce him officially in a minute, but I just want to let you know we're going to be talking about life insurance, and we all are familiar with life insurance generally in that it provides a death benefit to help support our families if something happens to us, to pay off the mortgage, pay off debts, get the kids through college. Those are the typical uses of life insurance, and we're all familiar with that. But we are going to be talking about some other uses that we make of life insurance in connection with estate planning and financial planning. So that's our topic. We are recording this, as those of you who are regular viewers know, we record this. The recording will be available on our website in a few days, absolutetrustcounsel.com. And so if you want to watch it again, or you have friends who you think should watch it, that's where you'll find it. Also, we turn these into a podcast episode, so just an audio, and that also will be on our website in a few days. And also it will be on whatever podcast platform you want to look for it, wherever you are used to listening to podcasts. So that's housekeeping item number one. Housekeeping item number two is that we are going to take questions from our live audience at the end of our conversation. So if you have a question while you're listening to me talk to JP, go ahead and type it in the comment section there on Facebook, and I will turn to them at the end and we'll get your questions answered. Okay, so I think that's all the housekeeping. My guest today, as I said, JP McDermott with Mass Mutual Pacific, is a financial advisor, and his practice focuses on working with entrepreneurs and small business owners. He helps them attract and retain top talent by using executive bonus plans and various other financial incentives, let's say. And he also helps the business owner and the entrepreneur themselves plan for their own comfortable retirement and to leave a legacy for their families. JP has an MBA, and he also is a certified long-term care planner. So he's got we're talking about life insurance today, but he has also lots of experience in the long-term care world, which is a whole different subset of what he does. He has more than 20 years of experience actually in the corporate world with big companies like AT&T and SBC. So he not only brings his financial planning expertise to his clients, but also, the running of a business, the management, the leadership, all of that. So all of that really benefits his clients. And without further ado, I'm just going to welcome you, JP. Thank you so much. I really appreciate you taking the time to talk to us. I know you're busy. We're all busy, and so I'm really glad you're here.
Well, thank you, Kirsten. It's nice to see you again, at least virtually, right?
Yeah.
And I'm honored to have the opportunity to, help educate some people, so when the time comes, they might be able to make some smarter financial decisions. So thank you.
You're welcome. That's always the goal. Okay, so we are talking live here today on November 12th, 2020. And some of you out there in the audience might be aware that 9 days ago we had an election. And that possibly has some impact on the kinds of things we're going to be talking about. We may see some changes in our federal estate and gift tax laws, maybe even in our income tax laws, if a Biden administration ever gets sworn in. And of course, depending on Congress, we still don't know the composition of our Senate, for one thing. But so I'm going to ask JP to talk about those possibilities. I just want to make it clear to everybody, this is all pure speculation, but it's interesting, and it's something that some of us really need to pay attention to, is what I'm going to say. So JP, what are you hearing? What are you reading about changes in tax law?
Yeah. So there's a lot of uncertainty right now in what's going to happen in the future, but there are some things we do know for sure. For example, the current estate tax exclusion for 2021 is $11.7 million per person, or about $23.5 million per couple. Most Americans don't have to worry about that. That's a good problem to have, but most of us are not necessarily at that threshold. However, on President-elect Biden's website, under his tax proposals, they're proposing to scale back the estate tax exclusion from the $11.7 million per person to the 2009 exclusion limit, which was $3.5 million. So suddenly, that's about a 71% reduction in that exclusion. Suddenly, a lot more people are going to be facing possibly estate taxes, and just simply anything over that amount that's over that exclusion will be taxed at a 40% tax rate, which is pretty hefty. Now, a lot of people don't seem to have to worry about that, but I'll give you some examples in a moment about some real life situations where you can see that there's some real advantages to being able to use some creative ways of life insurance to limit or even reduce the impact of that estate tax. And then the other thing we also know is if Congress does nothing, that current exclusion will snap back to the amount it was in 2017, which at the time was, I think it was 11, I'm sorry, no, it was, I had it written down here.
Well, it was $5 million based on, I think, 2011, adjusted for inflation. So
5.49. I see my number there now. So at any rate, if Congress does nothing, they will go back to that amount again, half of what it is today. So
right, it might be around 6 million. Again, it's adjusted for inflation, and we haven't yet experienced those years of inflation. So
that's true.
We can just guess. That's our best guess. Yeah.
So knowing that, I think, staying with that example, let's take Charlie. Charlie is a widower who owns 3 big apartment buildings, which is the bulk of his estate. And his estate is worth, let's say, $26 million when he passes. And he has 3 adult children. So without doing anything, the children are going to have to probably sell one of the apartment complexes to be able to pay the $1 million in estate tax.
Right.
But if Charlie had some good advice from his estate planning attorney, he may have taken out a life insurance policy for the purpose of paying those taxes. So he takes out $1 million life insurance policy and puts it in what's called an irrevocable life insurance trust, jargon, so that when he does pass, his children now have $1 million, and mostly these are income tax-free death benefits that they can use to pay the estate tax without having to sell the apartment buildings. So that's a simple example of how somebody could use life insurance in that situation.
Right, and we're going to talk about some other scenarios where life insurance can help in various ways, but that's a real simple example. We have an estate that's going to owe estate tax, and we have no cash. Okay, where is that cash going to come from? That could come from life insurance.
Right. Otherwise, the beneficiaries are faced with having to sell maybe the family business. It could be the farm. You read about these a lot because they hadn't thought about what's going to happen when mom and dad pass. So, yeah.
Right. And the other thing about the estate tax that's a little fun detail is it's due in 9 months.
That's right.
So if you have nothing that's liquid, you might be looking at a fire sale. You might be selling those rental properties at a little bit of a discount to make it happen fast.
Right.
And that's never good. That's never
No.
good. So that's a real easy, clear, basic use of life insurance is just let's make some liquidity for this family. Yeah. And so, JP, in conjunction with life insurance to solve an estate tax problem, and this is the most common use in my firm that we have for life insurance. I mean, when I have young families come in and people who have dependents, I'm always nudging them in the direction of you need more life insurance. But aside from that, the most common use is we're going to have an estate tax problem and we need to solve it. And oftentimes we couple the policy with an irrevocable life insurance trust, which in our industries, respectively, we call an ILIT, irrevocable life insurance trust. And that kind of amps up the power of the life insurance. You want to explain that a little bit for our listeners?
So life insurance in general is a terrific vehicle for passing on wealth. But when we think about getting a $1 million life insurance trust, if they did not have this life insurance, they would have to sell an asset to come up with that liquidity to pay the tax. Life insurance policies have this interesting benefit of using leverage. So if you think about $1 million life insurance policy, people do not pay $1 million for that policy. They rather pay premiums that maybe over a long period of time, they might put in half of that premium, $500,000 into the policy. But in most cases, it's much less than that.
Yeah. So
putting in 25%, $250,000 to get $1 million is, my book, a pretty good return. So whenever we're using life insurance for inheritance or leaving, legacy for others, it's a terrific vehicle for that.
Yeah. Right. And we can also, by putting the policy into an irrevocable trust, what that does for us is, if you buy a life insurance policy and then it pays a death benefit, that death benefit is considered part of your taxable estate. So you've brought some more money in, but you've also increased the size of your estate by bringing that money in. If we instead have that policy owned by a trust, an ILIT, then it's not part of your taxable estate. And in your scenario, we bring that $1 million into the family's bucket, but we're not going to pay tax on that $1 million. It's not the taxable estate. So you get a huge
benefit. Yes. Thank you for
that. Yeah. Yeah.
Right.
Okay. Right. So let's talk about some of the other reasons that we want to use life insurance in estate planning. We talked about we've got a lack of liquidity and we know we're going to have a tax bill. We've talked about that. Yeah. What's another reason?
So another reason is a blended family. So we have a lot of families that have sometimes more than a few spouses and children, and there's often a concern, that the wicked stepmother is not always just in fairy tales. Sometimes there is an anxiety by some of the children that, dad's going to forget about us if when he dies, we're not going to get anything. So a very simple way to solve that problem is for equity among all of the children is to be able to take out life insurance policies so that when dad does pass, that his children will be taken care of. So that kind of solves that problem of a blended family and the concern about, fairness and sharing the estate.
And
So,
just to be fair, it could
Yeah.
be a wicked stepfather.
Yeah,
We're just relying on these cliches for shorthand purposes, but and the other thing, sometimes with a blended family, it's not necessarily that they're worried they're not going to get anything at all, although that certainly is a concern, but it's also that maybe they don't want to have to wait. If my dad has died, I don't want to wait. Why should I have to wait 10 more years for my stepmother to die before I get my inheritance? And then, in some marriages, it could be a long time. Sometimes
it could be quite a bit longer, especially as, females statistically outlive us.
Right.
Won't go into all the reasons why, but that seems to be okay. So yeah, that's a
so
great.
It's a way to kind of make the family a little calmer about that whole blended family issue.
Sure.
So also, I think one of the things that here's an example of something that I see, and you can probably comment on, is if you're doing an estate plan and there's one asset that's important and special, and it's going to go to one of the children and not to the others. And most often it's something like a business. The family has a business. One of the kids works in the business, and the parents want that kid to have the business. But guess what? There's not a lot of other assets. I mean, as a business owner, I know there's not that much besides my business, right? You pour your heart and soul into it. So I think that's another opportunity. Yeah.
It's a very, very common one. I think probably, a lot of our clients are small business owners and they have children, some of whom work in the business, but some who don't. And so it's often a question, how can I be fair to all my kids? And because, John's going to inherit the business, but Susie is, she's not interested, but I want to make it fair. And again, having an estimated value of the business and what John will actually realize when he does inherit it, it'd be very simple for the owner to take out a life policy on himself or herself to be able to compensate Susie for the value that she wouldn't be getting from the business. So again, it's another creative way to use this strategy to be able to provide equity in a family situation. So
even a family that's not a blended family, these are siblings.
Correct. Right.
Without the extra money provided by life insurance, we just don't have the ability to treat them equally.
Right.
And co-owning a business with your brother or your sister, not always a good idea. So we don't. Yeah. We don't want to set them up.
Very few businesses last generation to generation to generation for those reasons.
Yeah, for sure.
Yeah.
So since we're on the subject of businesses, I think there's also a really strong need for life insurance within a business. There are a few different examples where a business really should own life insurance on the life of one of the owners or all of the owners. You want to talk about that a little bit?
We're dealing with a case right now. 4 individuals bought out the owner of a very successful architectural company, and they realized if something happened to one of them, if one of them passed away, they wouldn't necessarily have the funds in the business just yet to be able to pay that partner's spouse or partner.
Yeah.
So being able to what we call key person insurance, each of them estimated the value of the business and then took 1/4 of it to take out a policy on each of them owned by the company. So if one of them passed away, the company now has the money to pay their share to that partner's beneficiaries. Very common And one of the biggest challenges is, especially over time, a successful business that started off as a $5 million business, 10 years later, it might be $50 million, but they still have very low policies on it. So
yeah,
it's incumbent on us to make sure we're reviewing and keeping up to date with the value of the business. And conversely, we have businesses that are actually facing, their business has been cut in half. So, we have the opposite side of that too, that happens. But it's a great technique for being able to prevent your husband who didn't do anything in the business, but the spouse was the partner. Suddenly that husband is now a partner in the business and has all the expectations of the cash and the benefits.
Yeah.
This is a way to gracefully take that person out of the picture happily.
Right. Very few business owners want to be in partnership with their partner's spouse.
Yeah.
It doesn't work that way very often, and that doesn't work very well, I would guess. Okay, so I think that life insurance, just a little topic, can also be used to help people do charitable giving.
So it's again back to that concept of leverage. It's a terrific way to leave legacy back to something you believe strongly in, whether it's a charity, whether it's whatever it happens to be. Being able to simply have on a life insurance policy, have that let's call it a charity, be the beneficiary. And again, just for example, Sarah wants to leave $100,000 to the Red Cross, and she could have a savings account dedicated to that bequest to the Red Cross when she passes, but that's $100,000, whereas she could possibly take that $100,000 life insurance policy, and by the time she passes, she may have only put in $15,000 or $20,000 or $30,000 of premium into that policy, but the Red Cross is still going to get the full $100,000, and it's going to be income tax free. Other advantages, and again, I'm going from the charitable giving aspect back to just simply leaving legacy for children. A lot of people think that, well, I want to keep my retirement account intact so I can leave it as my legacy for my kids. However, what they don't realize is all the money in that retirement account, when you put dollar for dollar into that, and when they receive it, they're going to have to pay taxes on that.
Right.
Whereas if instead, enjoy that retirement account, spend it, but set up a life policy for your children where they'll get 100% of that income tax free, and you may have only put in a portion of what they'll actually get. So lots of different advantages for using it.
Right. Okay. I'm going to now turn to our comment area, and I think we do have a few questions here. Let's see. We have Gary Watts saying JP is the man.
No, okay.
So we know he's out there. He's
Gary's the money, I guess.
Thank you, Gary. Okay. Here's a question from one of our viewers. When is a good time to buy life insurance?
Wow. When's a good time to buy life insurance? Not to sound like a used car salesman, but life insurance is priced based on your health and your age. So typically, young people tend to be a lot healthier than we are when we're older. And of course, today you'll never be you're the youngest you'll ever be.
You're never going to be. Yeah.
So the short answer is as soon as you can.
Right now. Yeah.
And again, we didn't really talk about it, but life insurance is not something simply you can call up and say, like Amazon, I want to order a life insurance policy. It requires medical underwriting. You have to be in good health to be able to qualify for it.
Yeah. It's a process.
That's a whole different issue.
Okay. So how much life insurance is right for a person?
So again, I think Charlie was the single person who owned the apartment building. If he didn't really have a lot of people relying on his income for their livelihood or support, then he would need less than somebody who had 5 people that were dependent on him, and maybe they were still young and wanted to provide some money for education. So really, it depends. That's a good legal answer. It depends on everybody's situation.
I that's usually my answer to pretty much every question, except what do you want for dinner? But let me just say that I think there's a whole analysis that you go through when you're trying to really pin down how much life insurance is right for you, and it's going to depend on what it is they're trying to accomplish with the life insurance.
Thank you for reminding me. There's actually a lot of excellent calculators online, and one in particular that I refer people to is it's a third party called lifehappens.org, and it's got some terrific. You can do a real simple calculator, or you can do one that's a little more comprehensive that looks at what your income is, what are your debts, how many people are relying on you, et cetera, et cetera. So it can give you a really good idea of what's a good range for the right amount of life insurance.
Yeah. Okay. And then, of course, you're going to look at how much does it cost. So this final question that I'm seeing here is related to that. Why is term insurance so much cheaper than whole life insurance or permanent insurance?
So that if you'll indulge me just a moment. So there's 2 types of life insurance, right? You have term insurance, which is just as it says, it's for a set number of years, maybe 10, 20, 30 years, at which point, not exactly true, but it goes away. I mean, it doesn't exactly go away, but if you're paying $80 a month for 30 years, after the 30 years, it might go from $80 a month to $1,200 a month. So It becomes just unaffordable. But the other type is permanent life insurance, and that has a lot of different advantages. I like to use the analogy of renting versus owning. When you rent your housing, basically you get it for less expense because you're not paying for any of the maintenance and upkeep, property taxes, water and trash, et cetera. But at the end of the lease, you wash your hands and
you got to move out. Yeah.
There's nothing there. Whereas if you own your home, you're paying all those additional expenses, but also every payment that you make to the mortgage company, you're actually accruing equity in that property. And that's also true with permanent life policies. Over time, they can become assets. So they're more expensive, so that's term insurance. It's just simply pure insurance. There's no equity. There's no advantages to that. And it's very appropriate for most people in a lot of cases, but we also like to see some permanent life insurance in the portfolio.
Right. Yeah. A lot of the things that we've been talking about today are usually more appropriate for a permanent policy.
Right.
Things like, I got to make sure my kids have college tuition. If I die before that happens, that's maybe more appropriate for a term policy. That's just how I think of it. Yeah. Okay. Go ahead.
Well, I was just going to say one thing we didn't talk about, but also I think I know that your practice does a lot of this with special needs, is using permanent life insurance policies to fund special needs children when they become adults and the parents are no longer here. Having those funds available to help them maintain without jeopardizing their their social benefits that they receive from the state. So
right, and that is very true. Parents of disabled children really need to take a real serious look at life insurance, because they definitely almost always have a very big need for that.
Right.
Okay, I've got a couple more for you.
Yeah.
Could I use life insurance to cover a debt I do not want to leave to my spouse?
So the answer is yes. In fact, a lot of people get life insurance to cover their mortgage. And, they might have a $300,000 mortgage, although probably not in the Bay Area. And they can take out a life insurance policy and it could be a term policy, because if the mortgage only is 15 or 20 years, they could take that out simply to cancel that debt once if something happened to them during that period of time. So yeah, it's very appropriate for, as you can see, there's a lot of different uses for life insurance than what people usually think. So.
Right. Yeah. Okay. I have one more for you, and this is from our mutual friend, Gary. This may be outside of the topic a bit, but can you talk about a captive insurance company and how it may be beneficial for a business owner? Oh, that's really high level stuff. I don't know if you want to get into that. Maybe you can say 2 sentences about that.
Yeah, it depends.
That's one.
Sorry, Gary. I think we need to take this offline. But when you say a captive insurance company, there are a lot of insurance companies. Their advisors are captive to them. So I'm going to answer what I think I'm hearing, and then I'll try the second part. But at Mass Mutual, one of the reasons I chose to affiliate with them is we are actually independent, and we're not captive to their products and services. As good as they are, sometimes there's better alternatives out there that we're free to recommend and implement for our clients. The second part was as a business owner, I think. Could you just repeat that part again?
Well, I think he might be talking about a particular financial, I'm just going to call it arrangement, that is different from what you're talking about, but this concept of actually creating technically what is a life insurance company or life insurance situation without, and I'm mangling it. I'm totally mangling it because this is.
I think I know where he's going, and probably more appropriate. It is fairly fairly obscure, but I'd be happy to talk to Gary offline about that.
Yeah, he's saying privately owned insurance, and that is very, at least in my experience, that is very high level. Those are people who have very complicated situations and a lot of money. It takes a lot of money to set that up, but you get a big benefit if you can, So anyway, now you know everything I know about captive insurance, and it's not much. But anyway, JP, thank you so much. Thank you so much for being here, for sharing your expertise with us. It's been very, very informative, and I really appreciate you taking the time.
It's been my pleasure, Kirsten, and look forward to seeing you again.
Okay, you take care.
All right, bye-bye.
Bye. All right, now, as those of you who regularly watch know, I have to bring us home. But before I do that, I have to read a disclaimer that is necessary from JP's side. So the information provided here today is not written or intended as specific tax or legal advice. Our representatives are not authorized to give tax or legal advice. Individuals are encouraged to seek advice from their own tax or legal counsel. Individuals involved in the estate planning process should work with an estate planning team, including their own personal, legal, or tax counsel. So that's the Mass Mutual disclaimer. And now I'm just going to remind you again, this will all be available on our website, absolutetrustcounsel.com. And we do these Facebook Live things every other Thursday at lunchtime. And 2 weeks from today is going to be Thanksgiving. I can't believe it. Already Thanksgiving. So that means we're not going to have a Facebook Live on Thanksgiving. I wouldn't do that to myself or to my team or to you. So our next episode is going to be on the following week. It's December 3rd. Just so you know, for those of you who are just chomping at the bit waiting for that next episode. Thank you very much for joining me, and I look forward to connecting with you next time.